Imagine investing just $5 a day and turning it into thousands of dollars over time without stress, without timing the market, and without being a financial expert. Sounds interesting? That simple strategy is called SIP, or Systematic Investment Plan. Today I'll explain what SIP is, how it works around the world, and why millions of smart investors use it to build wealth step by step. SIP stands for Systematic Investment Plan. It means investing a fixed amount of money regularly, like weekly, monthly, or quarterly, instead of investing a big amount at once. Think of SIP like a subscription for your future wealth. For example, instead of investing $1,200 one time, you invest $100 every month automatically. Over time, your investments grow through consistency and compounding. This strategy is used worldwide in mutual funds, index funds, ETFs, and retirement accounts. In the United States, SIP works similar to investing regularly into index funds or contributing monthly to retirement plans like 401k or Roth IRA accounts. Let's understand this with a simple example. Suppose you invest $100 every month for 10 years, with an average return of 8% per year. Your total investment becomes $12,000, but your final value can grow to around $18,000 or even more depending on market performance. This happens because of compounding. Your money earns returns, and then your returns start earning returns. Over time, this creates powerful, long-term wealth growth automatically. That is why SIP is considered one of the smartest strategies for beginners. Many people ask whether they should invest everything at once or invest slowly over time. For most beginners, investing slowly through SIP is safer and smarter. First, SIP builds discipline because you invest regularly without thinking too much. Second, SIP reduces stress because you don't need to predict when markets will go up or down. Third, SIP helps with something called dollar cost averaging. Sometimes markets are high and sometimes they're low. With SIP, you automatically buy at different price levels, which reduces overall investment risk over time. This is one of the strategies used by professional investors worldwide. Another important thing to understand is that SIP is not limited to one country. It works globally. In the United States, investors use SIP through index funds, ETFs, retirement plans like 401k, and Roth IRA contributions. In Europe, many people invest monthly into long-term funds. In Asia, mutual fund SIP investing is extremely popular. No matter where you live, the idea remains the same. Invest small amounts regularly, stay consistent, and allow your money to grow over time. Here's the best part about SIP. You don't need a lot of money to start. You can begin with just $5 per week or $50 per month, depending on your budget. The amount is not the most important factor. Consistency matters much more than how much you start with. Even small investments can become large if given enough time. Time is the biggest multiplier in investing. SIP is especially useful for students, beginners, working professionals, busy people, and long-term investors who don't want to check markets every day. It works like autopilot investing. You set it once and keep investing regularly while focusing on your normal life. One of the biggest mistakes people make with SIP is stopping too early. They start investing but stop when markets fall. This is actually the worst time to stop investing. Market drops are opportunities in SIP because you are buying investments at lower prices. Long-term investors benefit the most when they stay patient during market fluctuations. So remember, you don't need perfect timing. You don't need a large amount of money. And you don't need expert knowledge to start investing. You only need consistency. Start small, stay regular, and let compounding build your future wealth over time. If you found this helpful, make sure to subscribe for more simple investing guides like this every week.